Hello guys, thank you very much for joining in. We're going to be starting out with this new chapter, which is liquidity risk. This is the first chapter of your liquidity risk management book. This chapter is slightly lengthy, okay, and hence we're doing it first primarily. And this chapter gives you a basics of liquidity risk. Some of the component related to your bid and ask spread is also there, and there are more specific things related to your liquidity risk management book, which is going to get tested again in detail in the further chapter. Okay, so with this, we would be starting out with the chapter, which is liquidity risk. Let us go to the first module. Okay, now whenever we used to talk about liquidity risk, there were two type of liquidity risk. The first was trading liquidity risk. The second was funding liquidity risk. Okay, what is trading liquidity risk? Where when you have an asset, you want to liquidate, you want to sell, but you are not able to find a proper market, or you have to sell at a very low price. That risk is called as trading liquidity risk. Second risk, which was your funding liquidity risk. Suppose you want to you don't have sufficient amount of money to pay back on the receipts or bills that are pending. Okay, so suppose there is a margin call, you do not have sufficient amount of cash available to pay back, sufficient amount of asset to give. That is where the situation of funding liquidity risk comes into picture. So now we're going to be focusing on the first risk, which is your trading liquidity risk. Now over here, when they started this paragraph, their main focus was to help you understand the concept of solvency. Okay, now solvency primarily means whether the company can be run properly or not. Okay, now they have tried to give you that concept of solvency in connection with liquidity. So they are trying to make you understand that if you're solvent, okay, that does not mean you might have liquidity available with you. Okay, that is what is the concept related to. Now I want you guys to read this entire first paragraph, the last 4 lines. Kindly read the same. Okay, what does solvency means? When the equity is positive, but the implying that asset exceeds liability on the balance sheet. This is a normal case that every other company that we see which is running, they're solvent. Okay, but there can be a situation where we can see that okay, it is solvent, but they might not have sufficient amount of cash or sufficient amount of highly liquid asset available to pay back on the obligation. Why? Because the liquidity primarily means that company should be able to pay back on its obligation, okay, whenever it arises. Okay, so that is the basic idea about liquidity. So that the first paragraph primarily focuses on that if you are solvent, that does not mean that you might have liquidity also. Hence, a lot of companies, what they do is they have different ratios to identify whether the company is having sufficient amount of liquidity or not. So we're going to be talking about net stable funding ratio, liquidity coverage ratio, all of it. Now over here, they've also given you an example of asset, which is primarily to investment grade asset and non-investment grade asset. In level 1, we talked about credit rating. Okay, so if your credit rating is above, if you have issued a bond and the bond credit rating is above BBB, then you are into investment grade. If it's below, that is called as non-investment grade, also called as junk security. So the trading is generally very high in an investment grade security, hence the liquidity is very, very high. And since we are talking about trading liquidity risk, okay, that is where this concept or this example is getting connected. Okay, when you have non-investment grade asset, obviously when it's a non-investment grade asset, people might not be that much interested in buying and selling. That means this liquidity on that asset will be slightly low. Okay, read the first paragraph, and if you're good till here, let us go to the next section. I'm assuming everybody is able to hear me properly. Give me a quick confirmation on chat. Everybody is able to hear me, right? Yes, let us go to the next section, the next paragraph. Now, whenever we are talking about a given asset, exchange is a different scenario, because exchange you have a clearing house, okay, which almost bears all the risk. Okay, but whenever we talk about OTC market, you face that credit risk and all of it. Now most of the discussion that we're going to be having is related to OTC market itself. Now whenever you deal in the OTC market, you generally deal with a dealer, and dealer will give you the bid price and the ask price. Okay, and what are the most easiest way to identify a price in such a scenario is to take a midpoint. Now the mid market price, okay, will give you the idea of how the selling and buying, at what price generally the selling and buying is happening. It's basically the average of the bid and ask spread. It's basically the average of the bid and ask spread. Okay, now let us look at this example, the next part, the real estate market. Okay, read that example. They are saying that real estate market is less liquid than the market which is driven through exchange. The reason being there is high credit risk involved, there is high transaction cost involved. Hence, there is not much of a trading happening in the real estate market. Read that second paragraph. Right, so if you're going to compare the two different markets, real estate market and an exchange market, the liquidity is very, very low in the real estate market. There are so many reasons associated with it. Okay, because of the ticket size being very high, because the property that you buy, okay, for example, in Mumbai, you will buy a property, it's going to be more than 1 crore rupees. So that ticket size being very high, hence the transaction is very slow. Let us go to the next paragraph. There is an important concept over here, which is called as predatory trading. And this happens with a lot of big entity. Okay, so for example, if I want to sell something, I have a lot of asset available and I want to sell and exit, but other players in the market, what they will also do is they will also start selling so that the prices goes down, and I would have to face a huge loss, because when I'm going to start selling, the prices are already very low. Okay, this is generally done so that a particular player in the market gets impacted. That is why the word predatory. So other participants in the market, they are explicitly doing this activity to impact one search market participant. Okay, so that is where this concept of predatory trading comes into picture. Right, so for example, Shivam, I know that Shivam is going to sell a huge amount of futures contract, okay, in the market, and I know that I want to make sure that he loses a lot of money, and I also own a lot of futures contract. I'll start selling that, and I also might have a cartel along with me who will also start selling, so that the price of the futures contracts goes down. Right, that is just an example. It can be some other part also. Mark this paragraph as star. So main concept over here is other companies can profit by placing an order before you. This was an example of buying. Okay, I gave you an example of selling. If you're buying and if somebody else is buying before you, then the prices might go slightly up, and it will increase your cost of buying. Perfect. The next paragraph. This is just an introduction related to liquidity risk that is being conveyed over here. The next paragraph, they're talking about that if you want to talk about liquidity risk, the very, very important component over here is transparency. If market participants do not understand or do not know related to the market, any transactions related to market, or if they do not trust the market, the liquidity is going to be very, very low. Okay, that is what is being highlighted over here. Okay, in the mid 2000 portfolios consisting of subprime mortgage, this is where they're connecting it back to 2007-8 crisis. Okay, but the main concept still remains the same. If the participants do not see the market as transparent, do not see that there is a trust in the market, they will not be able to trade. Okay, so read this paragraph. They're connecting it back to 2007 and 8 crisis. Okay, because that was a time when investors used to invest into a lot of high risky products, for which they were not having that kind of understanding with respect to, because the credit ratings were also not done properly. So investor, by looking at credit rating, they were investing a huge amount of money, and ultimately when the market crisis began, they started losing money, and they started hating the market. Primarily they realized that market is not safe, and because of which the liquidity went down. When the crisis started hitting, the liquidity went down. Everybody who was having money was not taking out money to invest into the market. There was a liquidity freeze. Okay, so we have completed till this paragraph. Now the main concept I want you guys to highlight from here till the concept of liquidity. Okay, market as star. So whenever you deal or you want to do any transaction into the OTC market primarily, okay, what would you do ideally is that you will go to a dealer. Okay, now dealer is generally an investment bank or some other primarily bigger company. Okay, and that investment bank would primarily give you a bid rate and an ask rate. Let us go and look at this example. Suppose there is a market maker standing in front of you, you are sitting over here, okay, and you are talking about buying a particular asset A. Or say for example, you go to the market maker with respect to asset A. He is going to give you two rates for that particular asset. Okay, suppose he's giving $10 and $12. So $12 is where you will buy and he will sell. Okay, $10 is you will sell and he will buy. So there is always a spread, which is this, which is basically the profit to the market maker. Because if you look at from the market maker's perspective, he's going to buy at the bid rate and sell at the ask rate. That is how he is able to sustain into the business, right? So bid and offer price is what the market maker gives for the asset. Okay, and like for example, offer price is where you would buy and the market maker is going to sell, and bid price is where you will sell and the market maker is going to buy. Now when you go and you want to do the transaction in the market, you see a bid and offer price. Okay, your size of the transaction will also impact the bid offer spread. Why? Because if suppose you're selling a huge quantity of asset, okay, then in that case a market maker will not give you a buy the rate of $10. He might give you a very lower rate, $9, $7, because he faces a huge amount of risk. Okay, so size of the order also impacts the spread and also impact the bid offer price. Okay, right? If there is a bigger order, the spread will increase. That has been given over here. Underline market. Okay, even financial asset without a market maker have implicit bid offer spread. This is primarily talking about buyer and seller fixing up the price. Okay, when you go to buy and sell, for example, if there is no market maker in between, if there is a buyer and seller, buyer might quote a particular price and seller might quote a particular price. That represents an implicit bid offer spread. There is no direct bid offer spread available if there is no market maker in the picture. Read this paragraph and we'll move towards the formula. All good. Let us go to the next section, and the formula over here is important. They want to identify proportional bid offer spread. Please understand, this is not a normal bid offer spread. This is a proportional bid offer spread. Okay, now the normal bid offer spread is straight away your offer price minus your bid price, because offer price is always going to be higher. Okay, but what they're trying to understand is that, okay, whatever this gap is, okay, compared to the current price or in proportion to the current price, what does it look like? So if you look at this formula, which is S, the numerator is your normal bid offer spread, bid ask spread, which is also called as the dollar bid ask spread. Okay, but the denominator is your mid market price. This mid market price is nothing but bid price plus the ask price divided by 2. Now why are we using this? Because it represents the current price of the asset. It represents the current price. So if your bid price is 10, your ask price is 12, so your mid price 11 will represent the current price of that asset. Okay, and that is what we are taking in the denominator, the current price. The reason we are taking this, we are trying to find this answer, is because we want to understand, okay, what is a bid ask spread in proportion to the current price. Hence it is called as proportional bid ask spread or bid offer spread. Okay, I hope everybody is good on the formula, the intention of the formula. Okay, now why are we looking at the proportional bid offer spread? Okay, because the main concept which is going to get tested over here is cost of liquidation. This is important formula. Okay, cost of liquidation. Now the reason over here is that suppose if I have a huge position available and I want to move out of that position because I don't need that position right now, or I have some bad information about the asset, so I want to exit, I want to unwind. Whenever I want to unwind or liquidate, I will face a cost. Why? Because suppose current price is 100, moment I start selling, the prices will go down. I will not be able to sell everything at 100. There'll be some asset which I'll be able to sell at 95, 94, 90, 89, like that. So I will always face the cost. Okay, the cost of execution, the trade, and liquidating the position, and that cost is represented by this. Okay, S, which we have already used. Okay, and alpha divide by 2. Alpha over here is mid market or dollar value of the position. Okay, dollar value of the position. Okay, that means we are converting everything into dollar value, even if that means the entire dollar value. Okay, and this formula is also shown over here in the question. Okay, I will come to this paragraph which is given over here. It is also important, but I'll come to this paragraph once we're done with the question. We'll try to verify the formula which has been given. A company has two equity position. The first is 2 million shares of ABC stock with a bid price of 25.5, ask price of 27. The second holding is 5 lakh shares, bid price of 45 and 46.5. Calculate the mid market value of each position. Mid market value, the first one. Okay, the proportional bid offer spread, this is S, right? This was the denominator, and the cost of liquidation in the normal market. Now they have used a proper word of normal market. Why? Because there might be a situation in an abnormal market. In an abnormal market, you might not be able to sell as fast as possible in a normal market because of the liquidity crisis or liquidity issue. Okay, so that is why they are explicitly highlighting that we are only talking about normal market. Let us look at the calculation. Okay, they are first doing the first, they are talking about the first asset, which is ABC company. The bid ask spread, this was your P in the formula. Okay, the mid market quote average, this is your denominator. Okay, mid market value, can we see this? The entire value over here, this was there in the cost of liquidating formula. Mid market value, proportional bid ask spread is nothing but your S. S is basically taking the P divided by your mid market price. Okay, 1.5 divided by 26.25. okay, this was the formula that we had seen. So now we are finding the proportional bid offer spread for both the first asset, which is ABC asset, and the second asset, XYZ. I want you guys to focus on the numbers and see if you are able to connect back. This is an easy sum. Okay, it can come in your exam. So the same part, bid offer spread, this is your P, this is your denominator. Okay, this was your mid market value, which we use for the cost of liquidation, and the fourth one is your S. Now look at this part. This is the main crux of the topic or the chapter. Now over here, they've used this number, which is a ABC asset mid market value. Okay, they are multiplying it with the proportional bid ask spread, and they're dividing it with 2. This was nothing but your S into alpha divided by 2. This was for the first asset. Similarly, we are doing it for the second asset. We are adding it. Hence the formula was summation. Look at this question and give me a quick confirmation on chat. Are we good till this point? You'll need to remember the formulas over here. Let us, if everybody is good till here, let us move towards the next section. Perfect. Everybody is good on the question. Okay. Now the additional part. Okay. Now whatever spread that we had, or sorry, whatever the S was, we assume that this S is going to be constant. Okay. we were not worried that, okay, during the stressed period, that this proportional bid-ask spread is going to move. So the next concept, which is over related to cost of liquidation related to stress market, can we see that this component is talking about this average plus some fixed component, gamma into sigma. Now this part is related to S. What they wanted to highlight that this proportional bid-ask spread, can we create some confidence interval, or can we create some movement or range of values through which the S can be defined in a better way, because the S cannot be constant during the stressed period. So they have taken mu, okay, which is the mean, sigma, which is standard deviation, and this part, the confidence level, okay, they have incorporated into it. We will see the calculation, and this question is also important because they might combine both of them and they might ask you in the exam. Assume that the same information from the previous exam, assume the mean and the standard deviation is given for both the asset, both the security, and the cost of liquidation that we want to find for 95%. And this is one tail. This is one tail only, because we are looking at the movement into one aspect. So the cost increasing, okay, the cost going towards the higher side. So if you look at this part, the first section, okay, now over here, what they have tried to identify the mean proportional spread. So we had, sorry, one second, my bad. Yeah, so I was talking about the mean proportional spread, okay, and the standard deviation and the proportional spread. So what they're trying to highlight is that, okay, if we are looking at the mean and the standard deviation, we are not directly using it. We can see that what we have done is we have done an adjustment with respect to, yes, with respect to the S part, 26.25, with respect to proportional bid offer spread, okay, because what we want to identify is that everything should be on a same level. Everything should be on a same level, because previously the S that we were using, it was proportional part, right? But over here, the bid of this $1.5 or 2.5 is mean and the standard deviation of the bid offer spread, okay, but we were looking at S, which is proportional bid offer spread, so we cannot directly use it, hence we are adjusting it. We can look at both the sides and being done for both the asset, and then we are using it into our formula, which is this. Slight variation over here. Look at the question, the entire question, and give me a quick confirmation on chat. The main point over here to understand is that they're not directly using 1.5 and 2.5, which was the mean and the standard deviation. Okay, because the mean and the standard deviation is for the bid offer spread, not for the proportional part, the proportional bid offer spread. So we'll have to convert and then use it. That's the only tweak. Perfect. And over here, we have used 1.645. This is similar to your level 1 Z value. Okay. Now the next component, which is going to come again over here, is that till now, till this sum, we assume that everything with respect to the spread, okay, is going to follow a normal distribution. But in real life, it will not be the case every single time. There can the distribution can have a skewness, or can also have kurtosis, which can change the distribution shape. Okay, so over here, when you're looking at liquidity, okay, that assumption can fail the calculation. So if you look at this paragraph, okay, they're talking about first line, normal distribution will not always follow. The second line being strong positive correlation between investment. Now, why this is a problem? Okay, the reason it is a problem, because if it's a non-normal period, the risk can increase immediately very fast, and because every asset in the portfolio would behave in a similar way. Hence, you have a liquidity adjusted VAR. This concept is also going to come again in your other chapters related to your liquidity risk book. Okay, so what we generally do is when we calculate VAR, we assume everything as normal, everything is as a standard behavior, and then we do this adjustment. Now this adjustment was your cost of liquidity that we try to found for both normal market and for stressed market, both for normal market and stressed market. So this VAR can be a delta normal VAR, straightforward VAR that we have already seen in level 1. Okay, the only additional part is that over there we were not explicitly taking liquidity impact, because if suppose if I am already holding an asset and I want to exit, I want to sell, I might not get the market. This will further increase my risk. So when you're calculating VAR, you calculate everything being normal and then you add the liquidity adjusted part, and hence the new VAR is called as liquidity adjusted VAR. Now once you're done till this point, give me a quick confirmation on chat, guys. Look at the formulas, mark the formulas as star. I know in the first 2-3 pages itself, we have seen so many different varieties of formula. But this is connecting back to your level 1 again. Perfect. Okay, let us go towards the next section, the further part. This is actually summarizing everything. Okay, but what they are trying to highlight is explicitly from the trader's perspective. Okay, explicitly from the trader's perspective. There's one more point over here. Trading volume per day. Let us go to this section. Let us read this part. Now, if suppose you have a huge asset available and you want to unwind, now there can be two scenarios. You can easily unwind, you will try to unwind fast, or you'll try to unwind slow. When you try to unwind fast, it is going to impact the price, because when you start selling, the prices will go down. Okay, because your position is very big. But if you, and that is primarily hitting you a risk that you might be able to sell everything but at a very loss. So you, in a very simple language, you might be able to sell but at a widening spread. What does it mean? Okay, look at the bid price and the ask price. Suppose the bid price is this and ask price is, and I want to sell everything to the dealer. Okay, so when I want to sell, he will be buying. So we are talking about the bid price. Now think logically, if I want to sell a very huge quantity, he might not give me 10, he might give me lower amount, because he might buy at a lower price. You might say, okay, I will buy at 7, I will buy at 8. So do you realize that the spread is widening? The spread is widening because of the size of the asset. So whenever I want to unwind fast, there will obviously a risk involved with respect to I am selling the asset at a low cost. That means I'm taking a hit. But if suppose I don't want to impact the price and I want to unwind slowly, okay, so obviously it reduces the, what do you say, the spread, because now my trade is not impacting the spread, but there can be situation that the market price itself is going down. Okay, the market price might move against me. Okay, so that is impact of slow unwinding. I want you guys to read this paragraph properly, understand the difference between the trying to unwind fast and trying to unwind slowly. Read that point properly. Let us move towards the formulas over here. Okay, what they are trying to highlight to you in perspective is that if suppose you are a trader, okay, you want to sell, you want to take a decision with respect to selling. Okay, now when you want to sell, obviously the cost will be there with respect to the bid offer spread, because you cannot sell at a higher price. You cannot sell at an ask price, you'll have to sell it at the bid price. Okay, so, and if you do the entire transaction of buying and selling, there'll be the cost of bid ask spread, because you're buying at 12 and selling at 10. That means the spread will always be there. Now let us look at the first formula which they want to highlight. Okay, they've used certain word as QP and QNP over here, and the impact is to find the total cost. So what is a P representing? Number of units traded in one day. That's the size of the market. Okay, the number of days over which you want to liquidate, that is represented by N. So suppose I have 100 units available with me and I want to liquidate in 10 days. So every day I will liquidate 10, 10, 10. Okay, because I have a window of 10 days to liquidate my position. I have decided that. Okay, that depends upon the trader. Okay, and the bid offer spread, which is represented by P. Okay, now over here they have not explicitly talked about the size of the trader's position after day one. Now why this is discussed only in variance and not this? Okay, there's a logic over here. So what they want to highlight, if you want to understand, suppose I start with 100 units and I have total 10 days with me to liquidate. So when the first day is completed, okay, I might have sold 10 units. Now my holding is only 90. So I only face a risk of 90. When I'm done with second day, I would have sold more 10. Then I'm only holding 80. So likewise, my risk will keep on coming down, and it is only going to focus on the risk part, or what do you say, the variance part. Hence, it is only coming over here. The X1. X represents what is the size of the position after one day. That means what is the risk that I have as a trader after first day. And this will keep on getting reduced as I move ahead in time. The first formula is only giving you the logic that, okay, if what is the bid offer spread, okay, and what is the total quantity that is traded in a day. So it helps me to identify the cost when I want to unwind. The first formula. Yes, have a look at that first formula. That's a cost for me, right? That's a straightforward cost for me. The second is the variance. Okay, now this variance is basically variance of the change in position. Why? Because when I want to sell, okay, or primarily the asset that I have available with me and the riskiness of that particular asset, it will, when I multiply it, it tells me that, okay, on an average, this might be the deviation in the price of the asset over a period of time. That is what the second formula wants to highlight. Okay, in a normal position, if you look at level one, we talked only about variance. Okay, what is extra over here is that this is not a normal situation where we are selling everything in one go. We're selling in parts. So my risk will also change depending upon what is my current holding, right? Because in level one, what we were actually looking at was sigma. If you go back to your level one, when we were looking at the variance or var formula, what we were doing is this was the var formula and we were multiplying it with the value, right? You realize this was getting multiplied by this in a very simple language. Okay, so what does it talk about? That the variance or the riskiness of the asset in terms of the dollar part, that is being covered over here. Okay, the third section, trader's objective is to minimize var, right? Obviously, because whenever trader wants to liquidate, he would try to minimize the cost and also the variance, right? And we can also see that both of the component the trader wants to reduce. Now there is a square root over here. There is a square root because it was a variance. They want to convert it into standard deviation. Hence, the square root has been added. Now I know these formulas are very tricky, okay, or kindly noted as slightly different than the previous formulas that we have seen, where there was some logic or some easy connection over here. I have not seen specific question related to this coming in the exam, but you should know the broad perspective of it. Okay, primarily if they want to test you, they might test you on the total cost itself in the exam. Okay, let us go to the next paragraph. Okay, an alternative way to measuring liquidity is the trading volume per day. Okay, what does it mean? If in a particular market the volume is very high, it means the liquidity is very high. This has been a normal barometer for the market, for the investors to identify whether a particular market is having a high liquidity or not. Now they have given some reference with respect to the researchers, what they have proposed in terms of the equation, because the previous equation that you have seen is also coming from a research, right? So in 2002, so the researchers have proposed that liquidity equation comparing the absolute value of daily returns or daily VAR volume over a specific time period. So they have given their own method to identify liquidity. Okay, some other researcher has said that okay, expected return are inversely related to liquidity. They have their own logic. If the liquidity is low, the higher the expected return. This is what we see, because real estate market being very illiquid, hence when you transact, you get higher returns. The returns are very high in the real estate market. That is being covered over here. Now this section, the last paragraph, is explicitly to connect back to you and tell you that okay, these formulas which you're looking at, these are one of the formulas that are used in the market. In reality, we have seen more research coming in, more theories coming in with respect to the liquidity of the product, and they're trying to connect it with different aspects. For example, the returns at price or like that. Okay, kindly read till this section and give me a quick confirmation on chat. Kindly read till this section and give me a quick confirmation on chat. The last line, I'm repeating the last line. Okay, so one of the researchers has been explaining, and what as per their research is that if there is an inverse relationship between your expected return when you enter into a transaction, when you enter into an asset, you expect a return, right? That return and liquidity. If the liquidity is very low, the returns will shoot. This is explicitly seen in markets, for example, real estate, or for example, paintings. Okay, because the transaction that happens at a very high cost. So whenever you enter, okay, you bought a property for 1 crore and you're selling it for 2.5 crore. So your returns are very high. Now, why you're able to sell at a high price? Because the liquidity is very low. Okay, and that is why returns are generally very higher. I hope everybody is good till this point. Let us go towards this question. They are asking you to find cost of liquidation in normal market. Okay, the bank owns 5 million shares of stock. The bid price is this and the ask price is this. Okay, if you want to find the cost of liquidation, what should be the formula? It was summation of S into alpha divided by 2, right? So yes, so let us go and try to find. Yes, first the bid ask spread, the normal bid ask spread. What would be that bid ask spread? Find the difference, 10.5 and 12.75. What is that bid ask spread? 12.75, it's 2.25 minus 10 point, it's 2.25. Okay, the mid market value, is going to be what? 12.75 plus 10.5 divided by 2, 11.6 to 625. That's correct. Mid market value. Okay, now if you want to find the S, it's going to be what? 2.25 divided by 11.62. So it's going to be 2.25 divided by, it's going to be 0.19355, right? Perfect. And what about this alpha? How will you find it? You will take the mid market price into 5 million shares. You'll get the total value. Yes. So what is the mid? It's 11.62 into 5 million. So this alpha is around 5.8. Like this. Is everybody able to get that? I'm getting 5.81. 581 if I'm not. 58, sorry, 58 point. I'm getting 58 million. 5 into 11.625. Shivam, kindly cross check. Okay, so what you will do is you will take this S, you will take this alpha, you will divide by 2. What is the final answer that you guys are getting? Is it D? You'll have to divide by 2 also. That's correct. Okay, 2 people. People are getting D and B also. Any more answer? Point 19355. Okay, I'm getting B. It's B. Yes, I'm also getting the answer as B. So what we have done is we have taken the S, we have taken alpha and multiplied it into divide by 2. Okay. Similar question that was there in the book, cost of liquidation. Let us move towards the next concept, which is your funding liquidity risk. So we talked about your trading liquidity risk. Now we're going to be moving towards the funding liquidity risk section over here. Funding liquidity risk means primarily we do not have money available to pay back our bills. Our creditors are standing at the door and we do not have sufficient amount of money. Okay, that means we do not have the ability to meet our requirement or obligation requirement. Okay, so if the company is having weak performance, then obviously the liquidity stress is going to be there. That means they might not have sufficient amount of money. Okay, and in 2007-8 crisis, we have seen the companies faced liquidity risk because there was a very big mismatch with respect to asset and liability. You can read this line. Mismatch when short-term investments are used to fund long-term requirement. What does it mean? So suppose if you have a bank, okay, bank will always have an asset side and a liability side. Now suppose a bank is taking money, okay, for say for example 3 years. Okay, it has issued a money, say for example a bond or certificate of deposit, like that. Suppose a 3-year bond has been issued to get $100 million, and what bank is doing, this is a short-term liability that they had created. They're using this $100 million to create an asset for 30 years. They created an asset for 30 years of that $100 million. That means there's no matching of the asset and liability happening over here. There is a clear mismatch. Okay, then that means primarily, if suppose after 3 years you have to pay back your liability, but you don't have the asset to exactly offset that liability. Okay, they generally preferred that a liability will be rolled on. That means I will issue a new bond for more 3 years and I will pay back the original bondholder, or I will restructure the bond for more 3 years. That was the basic understanding of the bank. Okay, but if there is a liquidity crisis, you might not be in a situation to roll over or issue new bond in the market. Okay, and this was a major problem which a lot of banks actually faced during 2007 crisis. There was a mismatch with respect to asset and liability. They raised a lot of money for very short period of time. Okay, and they invested it into structured product. So when the crisis started hitting them, they were not having, they had to pay back on the liabilities, but their asset was also not valued because the market was falling down. So they faced a lot of problem. Okay, so read this entire paragraph. I've just tried to give you a gist of what is happening over here. Read that paragraph. The first paragraph. Let us go to the next section. How does company tries to manage, okay, liquidity? So there are 6 primary sources. Now these questions might not come directly in your exam, okay, but this is just to give you an idea that whenever we talk about funding liquidity, how companies or banks are able to manage the cash and treasuries. Okay, that means one aspect would be to keep sufficient amount of cash holdings with you or in your bank account. The second would be to manage treasuries. Okay, that means you are holding government securities. Okay, now they've given you a reference with respect to US and UK government. It can be any government security because government security is risk free in a literal sense. Okay, and also it provides you with liquidity because that government security can be easily sold in the market. So if you want to convert that security into cash, it is possible very fast. So the first source of liquidity for the bank would be to cash and the treasuries which they have. Right. The second source, and I want you guys to read along with me. The second source would be the retail and the wholesale deposit. When we talk about retail deposit, what does it mean? Okay, customers keeping deposit in your bank account, saving account, deposit, fixed deposit, this can act as a source of money, because and generally these deposits are very sticky. That means you don't have to repay or don't have to pay them immediately. That means, suppose if I have a money in my bank account, I might not go and remove it fast, I might not change bank fast. Okay, so that is where the retail and the wholesale deposit means companies keeping cash into their current account, that can also be used by the bank as a source of liquidity. Okay, the first 2 points, kindly read the first 2 points. Now these 2 points are the primary source of money that bank has. The third point that we are looking at, which is trading book liquidation, that means whatever positions that I have taken in the market, I might have bought shares, I might have bought bonds, I will liquidate that to meet the cash requirement. Now generally this liquidation is done if you don't have the first two asset available, the first two primary source available, or else it is not possible for you to borrow from the market. Then only you will start liquidating your trading book. Okay, now obviously when you start liquidating, you might have to sell at a very low price and you will face that cost of liquidation. That's a different thing. Okay, so you can look at that cost from the normal and the stress period, but this scenario will only come into picture and the first two source and the borrowing is not happening, the trading book liquidity or liquidation basically. All good. Let us go to securitization. Now, originate to distribute model. Generally, what banks used to do is that they used to hold, suppose if I am Citibank and I have a lot of loans available on my book, what I can do is those non-core loans or those illiquid loans, which I don't want to keep on my books, I will do liquidation. I will do securitization. I will take those loans and I will create a new company, special purpose vehicle, and I will pass it on to them and I will get the cash. So through securitization, I'm able to offload my non-liquid loans or assets from my balance sheet to somebody else, and I will be able to generate cash for me to protect. Okay, and this was widely used by banks before the crisis as a means to offload those unwanted loans or illiquid loans, non-core loans from the balance sheet and get cash for that particular asset. The fourth point, securitization. This is also a source of liquidity for the bank, but this is not the major source. Okay, the fifth point is very, very important. Borrowing ability means interbank market. A lot of companies, a lot of banks, what they do is if they are immediate in need of money for half day or few hours, they will go and borrow it from some other bank. So the LIBOR market is primarily a London interbank market. If you look at US market, it's the federal fund rate. You have an entire federal fund network through which you can call a bank and get money for a very short period of time. You can also open a line of credit. You can also open a line of credit with some other bank to help you manage the stressed period. That can also be the case. Okay, borrowing ability. Okay, now they've used a very specific word in the first line. The stressed market creates more risk aversion. What does that mean? If there is crisis in the market, one bank might not be willing to give loan to another bank. Okay, that is the concept of risk aversion increasing for the banks during the stress period. They don't want to lose on the liquidity. They don't want to give liquidity to some other bank because they know the situation can get worse, and the counterparty to whom they are giving loan, that counterparty might also not be able to sustain the stressed period. Okay, so that is where your borrowing ability can get hit during the stressed market period. I'm assuming everybody is reading along with me. The sixth point is the central bank borrowing. Now, this is generally the last resort for any bank. This because you have to go to the lender of last resort, primarily your central bank like RBI in India, and ask for money. Okay, and they would take some asset and they will give you money. They will. That's where you're in India when you talk about the repo rate that the Indian RBI releases. That's primarily a rate at which the banks can raise money from RBI. Okay, the so obviously there will be a collateral involved, and because RBI will not give you money directly. Okay, so they've in the first three lines they've given you reference to providing money, okay, from the central bank to the banking sector. Okay, the cost is the collateral provided by the borrower. That means suppose State Bank of India needs money, they will give some collateral and they will get the cash for their particular product. Now it depends upon the collateral. The collateral is not good, there'll be a huge haircut. That means the central bank, when they pay you, they will not give you a right, they will not give you the full amount, because they will have to give some buffer, because there is some negative aspect with respect to the collateral. The collateral might be very volatile. Okay, and also, which is very very important part over here, this section, and this has been also repeated in one of the case studies, that if you're borrowing from the central bank, it gives you a negative publicity that you do not have money with you. Hence, generally banks do not go and borrow from RBI. Okay, because it gives a stressed signal to the market. Kindly read all the 6 pointers and give me a quick confirmation on chat. Are we good till this point, guys? So that we can start with the case studies. Darshan, line of credit means a bank has opened a line of credit with some other bank. In case they need money, they can raise money through other bank. They have a proper agreement in place. This is also done by companies. This is primarily done to mitigate any stressed period. If there is an immediate cash need, they can have the arrangement with the other bank and they can get the money. Moving towards the case study. Now these case studies are important for your exam. So mark all of them important. Mark it as star. Okay. The first case study is the Northern Rock case study. Over here, you'll find the reputation damage, the negative signal example also over here. So British Bank, which was heavily involved into mortgage lending, this is explicit to your structured product. Okay, this was related to your 2007-8 crisis. So where you are issuing a short-term debt, that means you're issuing short-term commercial paper, for example, for 2 year, 3 year, you're raising money and you're investing into mortgage-backed products. Okay, and this was the major strategy that Northern Rock was using. This was a UK bank. Okay, when investors decided or realized that okay, this strategy is not working because the structured product market is going down because of subprime crisis, so they were not willing to lend more money in terms of the short-term deposit to the Northern Rock Bank. And that is where the bank started facing the heat with respect to liquidity. They realized that okay, they need money and they started borrowing money from Bank of England. Okay, and because they were not able to get borrow money from the interbank market, they had to move towards the lender of last resort, and this created a problem because BBC broke the news. This was explicit, very very important part, that okay, BBC informed that okay, Northern Rock is taking money from central bank, and obviously this gives a negative signal to the market, and this triggered a series of events. That means a lot of customers started withdrawing money, which primarily means that there was a run on the bank. Okay, there was a massive run on the bank which led to £2 billion being taken out from the bank within a week. Okay, generally there was no problem as such with the bank, because the central bank do lend to normal banks in a situation like this, but this created a panic and a lot of customers started withdrawing, and when customers start withdrawing, it leads to loss of liquidity for the bank. Okay, now over here they have given you certain specific point. The deposit guarantee by the British government and the Bank of England slowed the run, but eventually reaching £25 billion within 6 months. What does it mean? Government also came out in support and stating that there is no problem with Northern Rock. We are there to protect you. Still the panic was there, and £2 billion, which we realized was there out in 1 or 2 weeks. Within the next 6 months, there was £25 billion being taken out from the bank. Okay, and since there was no money left with the bank with respect to deposit also, the bank has to be nationalized. That means the bank had to be taken over by the government. This case study is important from the exam perspective. Mark it as star. So if they had more sources of funding liquidity available with them, they could have avoided the situation of taking money from the central bank. Right? Kindly read the paragraph properly. Right? Moving towards the next case study, which is Ashanti Goldfields. Okay, small case study. Okay. Now, this was, see, Northern Rock was there in your level 1. Metal Gazelle chart is still there in the level 1. This case study was not there explicitly. Okay, a gold mining company in West Africa which sold gold forward to protect shareholder from declining prices in gold. Is this correct? That means whenever I'm mining gold, I always face the risk that I'm going to sell that gold in the market whenever that production is done, and I've got the gold and I'm going to sell it in the market, and I might not be able to get good amount of money because the market price has gone down. So how do you protect yourself? You're basically taking a short position in the gold forward contract, which fixes your prices of selling gold in the future. Okay. Now look at this part. This is what created the impact. Okay. In June 1999, okay, 15 central banks from Europe announced that they would limit gold sales for 5 years. Okay, that means they are not going to sell. So primarily, a lot of people, obviously, because if the market realized that there are going to be some restriction in terms of supply, there would be a huge demand coming in to cover up for it. Suddenly, you know that there is going to be no onion in the market after 10 days. You will try to buy and hold the onion. That same logic happened over here. When this event triggered, market participants reacted in huge demand, and that led to price increasing to how much? Price increasing to 25%. Price increasing to 25%. Now, because of this increase, the short position which they were having, they started losing. Why? Because the actual price in the market is very high, but you have to sell at a very low part, right? And obviously, if you want to make profit, then you'll have to go against the forward contract that you have done. Okay. Now over here, they have explicitly mentioned this led to margin calls. Now, what does this mean? Okay. Now in level 1, primarily, we have not explicitly said that, we have not explicitly heard that in OTC market you have margin calls. But where exactly this margin call is coming? Your counterparty, if he feels that you do not have sufficient amount of money, or you might be not credit worthy, then the counterparty might ask for a collateral. Okay, because he is in profit and you are in loss because you did short forward, the prices are going up. Okay, so counterparty will always be afraid that that you might not be able to purchase at a high price and deliver at low price, right? So because of which the counterparty will ask for a collateral, and because of when the collateral part start increasing, or when there is a need for higher collateral, okay, you as a company will have to give your asset, okay, to meet that collateral requirement or meet that margin requirement. And that is what primarily happened. Okay, they were in need of liquidity, or they were in need of cash to manage that margin call requirement. Okay, so this entirely happened because they did not anticipated that the gold price will increase. Okay, their only expectation was that the gold price would go down, and but because of some external event, the prices went up, and which against their hedge position, and they started losing money. Okay, read that entire paragraph, the Ashanti Goldfield part. Everybody kindly read this Case study, not so important for the exam. Not so important for the exam. The reason being this is very simple and plain vanilla case study. Okay, let us go to the next case study, which is primarily your metal gazelle shaft. I hope you guys remember metal gazelle shaft case study. We have already seen this stack and roll hedge from your level 1. Okay, so in a nutshell, what happened is that the company used short-term futures contract to hedge. Okay, they are long-term forward contract. On the forward contract, where they were saying that okay, we will be selling the oil to customers. Okay, so they had taken a short position over here, because what they had done a contract with the customer that after 10 years, after 15 years, I will sell you oil at this price. So they had taken a short position in that long-term forward contract. Now, if you want to hedge it, what they did is they went into stack and roll hedge. What was stack and roll hedge? For the benefit of the audience, okay, suppose you want to cover for 120 million barrels of oil, okay, over a period of 1 year, okay, and you know that after every month 10 million barrel will have to be delivered. So that is not a risk for you. Only the remaining part will be the risk. So when you enter into the first month forward contract, you will enter into 1 month forward contract. Okay, you will take a long position for 120 million barrel. When you reach over here, you will roll over to the next month. But when you roll over here, you will only roll over for 110. Not the next month contract is only going to be 110. When you roll over to third month, it's going to be only 100. Likewise, and it will keep on happening. So you stacked the entire your size of the trade, and you were reducing that stack. Okay, you were reducing that stack. So coming back to the example, so what they had done is they have taken a short-term futures contract and they had taken a long position in the same. When they entered into this contract or this position, okay, the market was like this: the spot price was higher and the future price was lower. So the anticipation was that the future price will go up and will touch the spot price. Okay, this is a very straightforward backwardation scenario. But what happened is that there was suddenly the oil prices crashed, and the scenario happened like this: the future price was high and the spot price was like this, and the future price now started going down to meet the spot price, and they had taken a long position in the futures contract, which led to a huge loss for them because the size was very huge. Like in my example, it was 120 million barrel, and because the market is going against them, they had to face a huge amount of margin call into their futures position. And from the forward position, nothing was coming because forward position will only get executed at the end. So they faced a huge margin call, and which led to a funding liquidity risk. I just tried to give you a brief snapshot. Okay, the company used, I'm just reiterating the points which I've explained. Company used long position in the short-term futures contract to hedge the supply contract. What was the supply contract? They had done a supply contract for 5 years, 10-year contract, which was fixed price supply contract. That means they decided to sell at a fixed rate. Okay, when the oil prices started falling, the future position required margin call. That led to a cash drain on the company. That means they were not having the sufficient amount of money. Okay, and they decided to close out. So whatever long position that they had taken in the futures contract, they decided to sell, but the position was so big it would have impacted the price. Okay, so that is where this decision of closing also can lead to a bigger problem. The closing of hedge led to a loss of around $1.3 billion for the company. Okay, the main problem was that they were not having immediate cash available. That means a funding liquidity risk to mitigate the requirement. This case is also important. Market is star. Read this paragraph, read this case study. I'm assuming everybody has been able to read till this section. Let us go to this last paragraph. Okay. Now to avoid this kind of situation where you might not have sufficient amount of money, a lot of banks, or suppose if you are into insurance business or pension fund, you have a lot of reserve requirement to make sure that you have certain amount of cash always available to mitigate that negative event or negative situation where you might lose or you might have to pay huge cash outflow. That is generally decided by the central bank. So specific percentage of the transaction has to be kept into their wallet. That is a reserve requirement of generally 10%. Higher the reserve, the better you have the capacity to manage those cash outflow situation. Read that last paragraph, and once you're done, give me a quick confirmation on chat. Right? 3 case studies: Northern Rock, Ashanti Goldfields, Metal Gazelle. Important is Northern Rock and Metal Gazelle. Let us go towards the next section, liquidity risk ratio. Okay, now these ratios we have already seen as a glimpse in level 1 in one of the chapters, a bank related chapter, and these ratios are also going to come again in the Basel related topics in operation risk. Okay, liquidity risk requirement as per Basel rule. Now they've got two important ratios which banks are supposed to keep: liquidity coverage ratio and net stable funding ratio. The aim of these ratios are primarily to make sure that whatever is a cash outflow requirement, you have sufficient high quality asset available to match that requirement. Okay, so banks are required to calculate what is the amount, what is the expected cash outflow over a period of 30 days or particular time frame, and to also calculate whether they have sufficient amount of high quality asset available with them or not. Let us look at this scenario. High quality liquid asset. Okay, look at the formula. High quality liquid asset, this is the numerator. Denominator is net outflow over a stress 30-day period. That means what is the total cash outflow that can happen over next 30 days, and that to explicitly stress period. Now if the numerator of this entire ratio, okay, if the numerator is bigger, then the entire ratio will be greater than 1. When it is greater than 1, it basically means greater than 100%. That means you have more asset as compared to your cash outflow. Okay, more asset as compared to a cash outflow. Now they've explicitly given a paragraph where they're saying that within that denominator of 30 days cash outflow, you should consider, okay, loss of wholesale funding. That means no other bank is willing to give you money. Okay, line of credit drawdown. What does line of credit drawdown means? Suppose you are a bank and you have customers who have taken line of credit from you, and during that 30 days period, those customers are also withdrawing money through that line of credit, and you cannot say no to them because you have a contract with them. You're charging a fees to them. Okay, so line of credit drawdown means customer withdrawing money through that line of credit. What is the partial loss on deposit? Customers withdrawing deposits. A downgrade of 3 notch in credit rating, and higher haircuts on secured funding. Higher haircuts on secured funding means to get money from the market, you'll have to give higher amount of collateral. Now what they have given you, the last paragraph, is that they have, when they're saying cash outflow, okay, net cash outflow for the next 30 days, it can happen with a cumulative effect of all of these things together. That is a denominator. So ultimately for the exam, you're supposed to remember the concept. Okay, there is very less chance that they might test you on the formula over here, but the concept has to be very clear that they want to make sure that whether you have sufficient amount of high quality asset available to match the cash outflow over a 30-day period. That was the first formula, liquidity coverage ratio. Okay, the next, net stable funding ratio. Okay, again the concept is same, but what they're trying to do is the denominator, how much do you need and how much do you have, the numerator. Okay, if your numerator is bigger, the ratio is going to be greater than 10, or greater than 100. That means 1 point something the ratio is going to come. Okay, that means you have sufficient amount of liquid or stable funding available. Stable funding means that is not going to get impacted during stress period. So that asset is available with you, okay, during that period, and you are able to manage the requirement for funding. That is being covered over here. Look at both the liquidity ratios. Okay, concept is important. And I would need a quick confirmation from all of you guys. People are not responding. Whether are you with me till this point? Once you're done reading the formulas, give me a quick confirmation on chat. What about Darshan, Samartha, Sanjana, Shivam? All good? Okay, so these formula, don't worry much. They are not generally tested, only understand the concept. Let us go toward the BIS principles, which primarily after 2007-8 crisis, they have highlighted that, okay, we should focus on this. Now, these principles also, they might ask some theory question with respect to a scenario. It's very difficult that they might ask you a specific explicit question on the concept, because it is very difficult to remember. So you can expect a scenario. Let us go to the first point. Fundamental principle of liquidity risk management and supervision. That means as a bank, you should have a complete framework of liquidity. Okay, that means how exactly you're going to manage liquidity throughout your bank, throughout your subsidiaries. Okay, that means you need to have some policy in place. Okay, and you should be able to identify which are your high quality unencumbered liquid asset. What is unencumbered means? You have not given that asset as a collateral to anybody else. There is no lien on that asset. You can directly use that asset. Okay, because if suppose I have an asset with me but that is being used as a collateral, or if somebody else is having a lien on that asset, I cannot use it directly. So we are talking about high quality unencumbered liquid asset which can help to protect the bank. Now this bifurcation or this understanding of asset is only possible when you have a proper framework or policy in place for the bank. And supervisors primarily means your regulators. They should also check whether a bank is having such kind of framework in place or not. The second principle, governance. Okay, within the banking system. Okay, not only at the supervisor level but also at the bank level, you should be making sure that whatever framework that you have, whatever practices that is standard practice across the banking system, is it being followed in the bank or not? And more importantly, there's one important line over here which says that whether that policy, procedure, everything is in line with the bank's risk tolerance level. See, you cannot be in a situation where your risk tolerance level is very high but you don't have sufficient amount of cash flow, sufficient amount of liquidity available with the bank. It will not work with that strategy. Okay, so whatever process or whatever way that we want to run the business, the governance point highlights that we should make sure that our policies, procedures, strategy, everything should be in sync with the risk tolerance level, okay, of the bank. And that should be monitored by the senior management of the company. And they generally have liquidity committee in place in a lot of bigger organization where liquidity related presentations are done. Okay, you have a specific liquidity team which will do the presentation. Okay, there is one more activity. You can mark this as star, the liquidity cost, benefit, and risk. Now, liquidity risk team is responsible for highlighting this to the company that, okay, if there is a scenario we don't have sufficient amount of money available, what can be the cost? Or if suppose there's a stress situation, if you want to move out of a particular position, what can be the liquidity cost related to it? What is the liquidity related risk that the bank will face? So everything will have to adjust according to that cost or risk. So your pricing of the product will also be impacted. Whenever you give approvals on particular products, liquidity risk related thought process has to be there. Okay, so this is primarily very operational activity, liquidity risk governance. Okay, kindly read till the first 2 points. Kindly read till the first 2 points. Let us move towards the next section, liquidity risk management and measurement. Okay, now over here where the actual policy which is in place with respect to the calculation and understanding the liquidity risk and incorporating it into pricing or incorporating it into decision making is done. Okay, so a sound framework has to be there to understand what can be the projected cash flow for the bank over a period of time. What are different sources through which you can get cash flow? If there is a liquidity mismatch, is there a possibility to raise money from the market during that period of time? And you can plan in advance to do that. The reason we are doing it, because if we are not doing this entire cash flow management process, the risk would be very high for the bank, because you will not be in control of liquidity risk exposure. Okay, and they have to do it across business line, across legal entities, across currencies. What does that mean? At the bank holding level, you have to manage liquidity at all your businesses, all your sub businesses, all your companies, all your legal entity, because a particular bank might have 10 or 15 legal entities also operating. So you have to look at liquidity need for all of them in one go. That is the second point. The third point, which is important, is that what they are highlighting is that whenever a bank wants to raise money from the market, they would try to create a pool of diversified funding source. They might raise money from central bank also, they might raise money through repo, they might raise money through interbank market, all of these different sources, so that if there is a problem in one particular market, it does not impact your ability to raise money. Okay, that is why this point is very important. Diversified source of raising money. Okay, and bank do calculate the way that we have seen the liquidity and cost during a normal period and stress period. So the need for money, okay, mark this is also star. The need for money during the normal and the stressed period, okay, will also be there for the bank. So because banks are also entering into a lot of trade transactions, so where you would find the settlement will happen, settlements are happening, clearing is happening, so you are in an obligation position also where you have to give money. Okay, apart from that, you have taken positions into market where you might get margin calls, so you have to manage that margin call also. So intraday liquidity is that concept, and the settlement is where you have already entered into a long-term contract where the settlement is going to happen or where the clearing is going to happen, and you are supposed to pay money. That is being covered over here. I'm assuming everybody is reading along with me, right? Let us go to the next section, active management of collateral position. Now, what does it mean? Suppose I have been entering into hundreds of trades where the collateral has to be used, okay, or I have to give collateral or I will receive collateral. Now, you need to have a proper team to manage how effective we can use collateral into different trades, okay, so that our trading or we are able to minimize the liquidity need from our end and use it as a position to leverage us or leverage the situation that has been given over here. So for that, you need to have proper idea where all different locations we have physical collateral being posted, what are the documentation related to collateral. Everything has to be proper, like which is mentioned, encumbered and unencumbered. Any asset which you have given as collateral, which is available with you, but you have somebody else is having right on that collateral or asset, that you cannot count, right? So you should be able to identify, or you should be able to bifurcate assets on that basis. Read this line and read till this entire point. I'm assuming everybody has been able to read till this point. Let us go to the next section. Stress testing is also important, because as a bank, we have to, when we run a stress testing program, it is not only from the market risk perspective or credit risk perspective, but also from the liquidity perspective, that whether there can be a scenario where we as a bank will face liquidity strain. We might not have sufficient amount of money to pay back. Okay, and till what level we can sustain. That is what stress testing will help you to identify and to change our strategies and policies according to the outcome of this stress testing. This is done very seriously by the banks. They have a proper stress testing program being run. So look at this entire paragraph. Mark it a star also. I want everybody to read the paragraph along with me. Okay, next is contingency funding plan. Now this contingency funding plan means if there is a bad scenario, how will we manage it? Okay, if there is an emergency scenario where we need money or any particular event has happened, we need to tackle it. So your contingency funding plan should have liquidity also included into it. Okay, liquidity like scenarios, or you need to make sure that you have sufficient amount of liquidity to manage that stressed or emergency like scenario. Okay, so because you have a specific team focusing on contingency funding plan. Okay, that is being created, taken approval from the board, taken approval from the risk committee, and circulated to all the teams so that each teams are aware about their responsibility when that situation arises. Okay, so liquidity, the contingency funding plan, there's also a chapter in operation risk related to this. Okay, so liquidity risk related to this. Okay, each party should know the responsibility, and liquidity should be a part of it. Perfect. Last part is connected to, is also important. It is connected to the previous point, that banks should be in a position to identify what all high quality unencumbered asset they have so that they can use it fast. Because if suppose there is an asset which is under dispute, you cannot use it because there's a legal case going on, there's a regulatory discussion going on, there's some discussion going on with other counterparty, you cannot use that asset. So as a bank, you should be aware about those high quality unencumbered asset which you can use immediately and fast to mitigate your losses or to pay back on the amount, right? I hope everybody is been able to read till this point. Very much theoretical. Okay, I've tried to highlight important points for each section. Okay, focus on those points. Okay, generally they might give you a scenario like situation to identify how will you deal with that. Let us move towards the disclosure and supervisory responsibility part. Now, disclosure is where the bank is giving information to the regulator. They will have to share the policies, procedure, the framework that they are following with respect to liquidity on a regular basis, primarily or quarterly or a semi-annual basis. They give information to central bank. Okay, so that the bank is aware, the Reserve Bank is aware that the banks are doing appropriately with respect to liquidity management. This is very simple and straightforward. This is a normal regulatory requirement. What is the responsibility of supervisors? Okay, that obviously whenever you get the data from the bank, you have to do your comprehensive review. Okay, whatever information that you have with respect to market, whatever is happening in the market, use that information to ask for additional reports from the bank so that you as a company, or sorry, you as a regulator is aware about the soundness about the bank. Okay, so supervisor have to ask for a lot of information, details from the particular bank. So now they have talked about Prudential Report. This is generally done in UK, where banks have to submit a particular type of Prudential Report with respect to their liquidity requirement. Okay, and to make sure that their risk management is being run in a proper way. If they find any issue with the bank, okay, you have to give guidelines to the bank to address that deficiency so that the liquidity position is coming back to the normal situation. And regularly talk to the public authorities and other regulators in other field, informing them about what is the status and to learn from each other. That is the last point. Now, this entire section is not very important for the exam. This is a very general activity which all of the regulators generally do. I want everybody to just read till this point and give me a quick confirmation on chat. Are we good till this section? Let us go towards the next part, which is the question 61.2. Okay, which of the following statement, okay, accurately reflects liquidity management for a financial institution? Accurately reflects. An investment in treasury security helps a bank increase its risk and return profile. Does investment in treasury helps you to improve your risk and return profile? Read all the options properly. Central bank borrowing are relatively cheap ways for banks to stay afloat. I want answers from you. Stability in retail deposit over the year has enhanced bank liquidity. Which of them is accurate related to liquidity management for the financial institutions? I also want you guys to go and cross check the answer. A lot of people are saying D. Stressed market can limit effectiveness of trading liquidity. Yes, the reason being, see why? Because what is trading book liquidation? That you are selling your asset, but if the market is stressed, it might not be able to sell that. So it creates a limitation for you that you might not be able to raise money through that activity. Right? See, A was straight away wrong because you don't invest in treasury to get higher rate risk and return. Okay. Central bank, even though it is cheap, it might not be a good way for banks to raise money. Okay. Right. Now, stability in retail deposit. This can be the answer, but D seems to be more correct. I want you guys to cross check at the back end also. Which, let us go to the second question, which of the following factor must be taken into account in net cash outflow for 30 days in terms of LCR, the denominator. What was the numerator? High quality asset. Denominator was net cash outflow for 30 days. Which of the following was there as a denominator part? Two-notch reduction in credit rating, large haircut on secured funding. Read all of them. Partial loss of wholesale funding, a complete loss of deposit. If I'm not wrong, it was partial loss of deposit, and complete loss of wholesale funding. So these two definitely goes out. What about C and D? Two-notch reduction in credit rating or large haircut on secured funding? Right. Yes, it was 3-notch, right? The answer is C, large haircut. Even though you're giving a secured funding, that means you're giving asset. You have to take haircut because the asset might not be as good as it might see. Okay, or the counterparty might feel that the asset is very risky and they might ask for a huge haircut, and you will have to give more asset to cover or to raise money from the market. Moving towards the third module, after which we'll take a quick break. Okay, there's a concept driven question, which is the liquidity black hole and positive and negative feedback trading. Let us first focus on this part. Market as star, liquidity black hole. Okay, it basically means that's a situation where you want to sell, but everybody else also want to sell. It creates a situation that everybody is on the same side of the market. Everybody wants to sell. That means there is no buyer available. That is where your liquidity black hole comes into picture. Okay, dried up liquidity because everybody wants to be on the same side. Either everybody wants to buy or either everybody wants to sell. Okay, it is also referred as crowded exit. When you want to sell, there's a huge crowd out there. Okay, and because of which you don't see much liquidity in the market because there are no buyers available. So you have to sell at a lower price. Mark this as star, liquidity black hole. Also remember it as crowded exit. Crowded exit. Read the first paragraph, market as star. Okay, let us go to the next scenario, which is this: traders can be categorized as positive feedback traders and negative feedback traders. Positive feedback traders means you behave with the market. So if the market is going high, you will buy. When the market is going down, you will sell. Okay, so you are pro-cyclical. You behave with the market. But what about negative feedback traders? They behave in a very different way. If the market is going down, you will buy. Like Warren Buffett. They will wait for the market to go down. Value investors, they will wait for the market to go down. Okay, so they will buy when the price falls and sell when the price rise. So if you look at properly, this negative feedback traders, they actually bring stability into market. So because if the prices are going down and they are buying it, so they bring stability in the reduction of price. They bring stability into the reduction of price. Yes, it can also be termed as momentum. Positive trading for positive feedback traders can also be called as momentum traders. When the market is very high, they buy. When the market is very low, they sell. Okay, and ideally what should happen is, in a normal market, both positive and negative feedback traders should be in sync. Okay, because if one group is dominant, suppose if the positive group is dominant, it's gonna be, then the market will move fast into a direction. Okay, when the market is considered liquid, this is important. A strong balance of both traders as a group is needed to keep the market stable. This line is important. Read that last three lines. So what they're saying, as buying during price decline, selling during price increase will keep price stable. This point means that negative feedback traders bring stability to the market. Do you all agree to that? Because positive feedback traders will push the market into a particular direction. Only the negative one will bring stability. Fairly simple. Now these two concepts or these two paragraphs are important for the exam. Now that they have given you certain pointers related to this section, okay, which highlights why people move towards, or why traders move towards positive feedback trading, or why it happens in the market is also explained. Okay, now look at this first two lines. What they're saying is that the opposite situation occurs when the positive feedback trader dominate. That means price increase happening excessively or price reduction happening excessively, right? If the positive feedback traders are dominant, then there is no stability in the market, right? It will lead to more illiquidity because everybody is buying or everybody is selling. So it brings a lot of destability and creates illiquidity in the market. Now, reason why such a scenario is happening, the first reason, stop loss rule for traders by triggering sales whenever the asset price falls below. Do you realize that when you trade in the market, suppose you have bought something at $100 and you feel that the prices might go down, so you have already put on a stop loss. Okay, you have bought, you have taken a long position. Now you fear that the prices will go down. You put a stop loss at $90 of sell. Now this is automatically put. This is the general practice that lot of traders do to reduce their loss, because if the price goes down and touches 90, it will automatically sell. So do you realize if a lot of traders in the market are putting this stop loss strategy, it is actually acting as a positive feedback behavior. Why? Because when the asset price will fall, it will automatically sell. So more people are selling when the prices are falling. Right? That is what the first point highlights. That is what the first point highlights. Okay. Trend trading occurring. This trend trading is similar to what you call it as momentum trading. Okay. When the asset prices are rising or they are at higher trend, okay, you try to buy it. Okay. And when the asset prices are going down, you try to sell it. Okay. What is breakout trading? Okay. That means a trader behaving against the trend. Okay. But what the point they want to highlight is that if there is a trend trading happening in the market, that will also lead to a positive feedback behavior. The second point. I want everybody to continue reading with me the points. The next section is predatory trading. What is predatory trading? If I want to sell, I'm a very big player in the market and I have a huge quantity of a particular asset. I want to sell. Everybody else in the market will also sell so that I lose money. That is predatory trading. But because of this predatory trading, do you realize for positive feedback trading is happening? Because people are selling when and prices are going down and I am also selling. So it will lead to a more decline in price. So predatory trading can also impact or can lead to positive feedback trading. Kindly read that line also. So first 3 points are not very difficult as such. Let us go to the next 2 points. The fourth point over here, a short call position can be hedged by buying the underlying from the market. Which position is this? What do we call it? Short call plus long stock. What do we call it? You've seen this in level 1. What do we call it, guys? Sorry, this is short call, my bad. Short call plus stock. Is it covered call? Is it covered call? What was protective put? What was protective put? Long put plus long stock. Right. Okay. Coming back to the paragraph. A short call position can be hedged by buying the underlying asset after the price increase. Why? Because when you take the short, this situation, it is like this. You have already taken a short call and you have bought an asset. So this is your asset, this is short call. When the asset price is going, that is when you face the risk. So when the asset price is above the strike price, you will buy the asset to cover your short call. Okay, to cover your short call. Hence we call it as covered call. Now think about this. If the bank is having a large short position, okay, that means it can lead to a lot of risk for you because you might have to properly hedge. But if the hedge is not happening properly, that can lead to big amount of market liquidity risk for you. For example, okay, suppose you have taken 100 short position in call, but you have just taken 10 long stock ideally. Then when the asset prices are moving high, okay, you don't have sufficient amount of asset to protect this. It can lead to liquidity going out of your company because you're losing a lot of money. That is where the point highlights that you might lose liquidity because the hedge is not properly done. Right? This is generally with respect to a passive hedging. If it's dynamic hedging, you might buy more, you might change the position, okay, to make it more of a, what do you say, a hedge, more of a hedge. Okay, but think about this. Looking at this scenario, what is happening when the asset prices are increasing? You are buying asset. That is a behavior of a positive feedback trader. When the asset price is increasing, you are planning to buy asset to cover your short call. Right? Read this first 3 lines. Read the first 3 lines properly. First 3 lines, yes. And the next point. So this is one kind of behavior where you have taken a short position in the option and you're protecting it with that. Okay. Now, in that case, this was one particular situation which leads to positive feedback. They're also talking about one more scenario, which is negative feedback. If you have taken long call or put and you're shorting the asset or purchasing the asset primarily. Okay, if you're taken a long call, what is the scenario that you see? Right, so you basically, if you go over here, sale after the price has increased and purchase after the price has decreased. Right? Why? See, if you're taking a long call, you're going to make profit when the asset prices are going down, going up. So if you've taken a short asset, okay, that will nullify your position. You're going to lose over here, you're going to make profit over here. That way. Right? So think about this situation. Suppose if you have already taken a short position, short stock, okay, and you are worried about asset price going down, so you can take long call to protect it. Do you agree? Do you agree with this situation? Right, this is the first situation. Similarly, for put option, okay, suppose you have taken a long position in stock, you're trying to protect it by buying a put, right? Now think about this being done simultaneously. So when the asset prices are going high, you're taking a short position in the stock. When the asset prices are going down, you're taking a long position in stock. This is inverse behavior. This is negative feedback trading, not the positive, because in the positive, when the asset prices were increasing, you were buying. Over here, it's inverse that is happening. It's inverse that is happening. The next three lines. Are we good till this point? The fourth point. Give me a quick confirmation on chat. Read the entire fourth point properly. All good with this fourth point? I'm moving towards the next point. The next thing, the fifth point. Okay, mark the fourth point as star. Something different. So you should remember it that way. Now look at this. A long position in option is sometimes created synthetically by short position in the same option. Right. So now what they want to highlight over here is something. Okay, this word synthetically, you've already seen in put call parity, that if you want to create a particular position, okay, into the market, you can create that by using put call parity, and you will be able to create long put, long short, short put, long call, short call, likewise. Okay, they are highlighting in the first two lines that it is possible to create. Okay, now let us go towards the next line. The stock market crash of 1987, okay, will give you some situation with respect to positive feedback trading. Okay, now the main part starts from here. Okay, and definitely refer to the Black Monday. Trading rules, the main section is that the trading rules were established which were structured to create synthetic put on portfolio over $60 billion. Synthetic put, that means there's no explicit put available, but you're creating a put. Okay, the rules involved buying equity when the markets increased and selling equity when the market decreased. Okay, this led to now if that kind of rule is there, what is going to happen? The market price will increase steadily, or it will, when it start decreasing, it will start decreasing steadily. Okay, and that is what primarily happened over a period of time. Okay, that means see much as 10% declining happening in a particular day, right? And they've given you some numbers also with respect to $4 billion being sold on a Friday itself. Okay, and Black Monday being a situation where excessively market is falling. This also happened after your 9/11 attack or Mumbai attack, all of it. So all of these scenarios where the massive selling happens, that scenario where the market falls in a very big number, or a particular stock falls in a very big number, we're calling it as Black Monday. Generally, Black Monday is referring to the entire market. Okay, read this entire paragraph. Read this entire paragraph where they're explaining you a scenario of the 1987 crash. Okay, what happened in that market? Okay, a steady decline, a steady increase, and they have given, obviously this scenario is there in your book because there has been a Black Monday situation, there has been a decrease. They're explaining you that scenario, what happened on Friday and how much they lost. Read that entire paragraph. Not so important for the exam, but this is just for your reading. Let us go to the next situation. Mark this next situation is also star. margin call situation. Now think about a scenario where you have bought asset, you have taken long position, okay, into an asset of $1,000, and all of this is through leverage, or majority of this is through leverage. That means suppose you have bought it through margin trade. When you're saying margin trade, you're borrowing it from the broker, or suppose you have bought it from market, the $1,000, or suppose out of $1,000, $900 is being taken from the market now, and you are expecting that the asset price will go up. Now if the asset prices are going down, okay, you will face a margin call. If you do not have money available to pay the margin call, you will think about liquidating this position. That means going out of this position. When you liquidate, you will sell, and when you sell, the prices will go more down. Okay, so because of, and why there is a pressure on you to sell, because you have taken a huge leverage to buy $1,000, and you're facing more margin call on it, and you don't have money. So hence it will trigger a scenario where more selling happens, because you are exiting the market to reduce your leverage, to reduce your margin call. You're selling, and it leads to more price drop, and more margin call is coming. It becomes a loop. That has been explained over here. Mark this as star, the entire paragraph. Kindly read that entire paragraph. The next case is LTCM, long-term capital management. We have seen this in level 1 in detail. Long-term capital management was created by Nobel laureates, and they were very, very influential people as a principle of the fund managers. And what they were doing is they were using some mathematical tool, some statistical tool to identify, okay, certain anomalies in the market. Okay, for example, they realized that in certain market, the historical average volatility is this. In certain market, the average volatility, the current volatility is very high. In certain market, the current volatility is very low. Okay, and they realize that, okay, we will take because this is going to converge to the average over a period of time, we will take position accordingly. Okay, and that is what they were trying to do, and they did a lot of relative value trade in terms of bond, primarily a fixed income market, into volatility market, credit spread market. They took positions into it, and they had taken short position in liquid bonds and long position in illiquid bonds, realizing that the liquid bonds prices will come down and illiquid bonds prices will go up over a period of time, and they will make profit in both the situation. But when the Russia defaulted, it created high risk into the market, volatility increased, and everywhere their position, wherever they had taken position, things happened in opposite way, and they started losing money. Now, since their position was highly leveraged, they had not even taken accounting leverage perspective, but there was an economic leverage also, which we have already seen in level 1. What was economic leverage? That brokers were not asking for initial margin from these traders, and because of which they had money to take on extra trades. Okay, and because of this high leverage, when there was a margin call because of the loss, they were not having money, and I think so within the first month they lost around 40% of their equity. So that is also being highlighted over here. And when they started closing out their position to meet the margin call, the spread widened. Spread widened means they started facing loss and the prices went down. So prices going down and you are selling. That scenario is represented over here. Read this paragraph. Is everybody okay till this point? Is everybody okay till this point? Okay, let us move towards the next section. Mark this as star, the leveraging and deleveraging section. Mark it as star. Now, this leveraging part, okay, where excessive borrowing is happening throughout the economy. So now suppose if the banks, if the government has reduced the rate, lending rate, banks are able to give loan at a very low rate. Okay, people are able to get credit easily. They are able to raise money at a very low cost. Companies and investors. So now because of this, what is going to happen? More money is going to come. Money supply will increase. They will put in more factories. More production is going to happen. The prices on an average will increase because now everybody is having money. Okay, so that will lead to inflation. And when this happens, okay, when this is a situation now, the obviously over a period of time to curb on inflation, the government will increase the rate of interest. That is a different point. But what they're highlighting is that when there is high leverage in the economy, the prices are increasing. Now, if you have given an asset as a collateral, think logically, the value of that collateral is going to increase. That means you can use that collateral to cover more margin calls or more loss like situation. Okay, or else think about this, that suppose if you have given a collateral and you have raised money, now if the value of the collateral is increasing, you can raise additional money using the same collateral because there is high leverage and because the prices are increasing. Now opposite scenario would be deleveraging, where the leverage is going down because the interest rate in the market is very high. There is no liquidity available in the market. That means people are not borrowing money from the bank because the rate of interest is very high. Less economic activity, less production, less salary hike. Okay, and because of which the prices will not increase, prices will go down. For the same collateral, you are not able to raise a sufficient amount of money because a haircut will lead to you getting lower amount of money. So your borrowing part will get reduced because the price of the asset is going down. Okay, previously for $100 asset you were able to raise 90. If the prices are going to 110, you can raise 92, 95, 97. But if the prices are going down, you cannot raise 90. You will have to raise 80, 85. That is the impact of leveraging and deleveraging. Mark this paragraph as star. Important for the exam. In case of any queries, kindly put it on chat. I'll try to address it as soon as possible. Let us go towards the next section. If everybody is okay with that paragraph, let us move towards the last two paragraphs of the chapter. Okay. Now they've explicitly highlighted US market during the mid 1980s. They've coined a term which is called as irrational exuberance. Mark this term as star. This can get tested in some theoretical concept. Okay. This was being given by Alan Greenspan. He's a very famous Federal Reserve uh, chairman primarily. Okay. Now what he's talking about, he's talking about a scenario where large asset purchase increase price. Okay, people are buying more and because of which prices are increasing, and other people are feeling that okay, the market is growing. Okay, that means an asset, suppose if I go and buy Yes Bank 5 lakh shares, the prices will go. Everybody else in the market will feel that okay, Yes Bank is doing good, it might be profitable, hence the prices are going up. More people will come, it will push price more, and more people, more investors will enter and keep on pushing the price. This scenario is explained as irrational exuberance, when that means everybody is happy but for no reason. Everybody feels that the asset is going high but for no reason. That is why it is exuberance, means we are very happy, very uh, you feel that the market is going high, but there is no rationale behind that situation. And that is similarly happened in US housing market, where the prices were increasing over a period of years, and that obviously bubble burst during 2007-8. But there was no explicitly economic logic for the increase in the housing price, and everybody wanted to participate in that. So this irrational exuberance as a logic you should remember. Read that entire paragraph. All good? Irrational exuberance. Let us go towards the next section, the last paragraph. Last paragraph is kind of summarizing things, and it focuses on that regulatory requirement across the globe should take into consideration the banks, the challenges that the bank face. For example, banks can have different time horizon, risk profile. They are different from a pension. Different regulatory requirements are there for pension funds and insurance company. So applying regulation for different variety of people, this banks will help them to manage their liquidity in a better way. Okay, not everybody can deal with liquidity in the same way. That is what they wanted to highlight. This is just for your reference, nothing specific can be asked from this paragraph. Read that paragraph and let us move toward the quiz. Complete the paragraph. And let us go towards this question. A high liquid market tends to result from situation where, which of the situation would lead to high liquid market? Stop loss rules affect the price decline. Will this lead to high liquid? No, because the prices are going down. Negative feedback traders sell share when the prices rise. So they are bringing stability. That means they are bringing liquidity. This can be the answer. Positive feedback traders purchase the asset as the asset price rise. No, they are either increasing or decreasing. So this is not bringing any liquidity in the market. Breakout trading occurs because of price moving outside of a range. Not exactly. Okay, but if you look at point D and B, B seems to be more inclined towards liquidity. Okay, so if I'm not wrong, this is the only question we have in the third quiz. Right, we are done with this chapter. Any queries, guys?